Getting a home loan for the first time can be really scary. So I'm going to break down some of the key things that you can do in preparation for this so that you can put your best foot forward when you apply. So the first one, servicing interest rates. So people are often surprised to hear that the bank is required to assess you at a higher rate than what you see advertised. So this can be as high as 3 to 4% higher than the advertised rates. This means what you think might work when you use your own calculations may not actually work for the bank. Number 2, having clean bank accounts. So what is a clean bank account? So no unarranged overdrafts, missed direct debits or automatic payments. The banks refer to this as account conduct. They basically just want to see that you've got some really good money habits and aren't spending more than you earn. Typically, when you apply, you have to provide 3-month statements for all your bank accounts and credit cards and bits and pieces. So it's trying to make those 3 months look as good as you possibly can. Number 3, spending less than you earn. So it's pretty obvious really. The banks just want to see that you're capable of living within your means and therefore they're going to get their money back when they give you a loan. Most people don't realise that the banks have a minimum level expenses they'll factor in depending on your living situation. And this is different if you're a single person or if you're a couple or if you've got kids. When you apply, you must include a budget. This is where they will check this against your bank accounts. They will take the higher, so it's either their calculations or your budget. And this has become or credit card payments. However, look, life does happen and sometimes things get missed. In this situation, it's best just to be as upfront as you can, own your mistake and explain what happened and how you fixed it. The banks will look at these reasons, at why it happened and how long ago it was before they jump to any conclusions. And then 5, impact of credit limits, loan payments and afterpay. So open credit card limits, even if they aren't used or if they're paid back in full, will be factored in by the banks as an expense. So if you've got a credit card with a $10,000 limit that you don't use, that could be negatively impacting your application by about $300 a month. So it might just be a matter of lowering some credit limits before you apply to make it look more attractive. Loan payments, including your student loan, are taken into account. So sometimes consolidating and repaying debt can make your case look better. And then things like afterpay are really interesting. It shows up on your credit report and banks will treat these like they're a loan if they're really regular. So the best thing you can do is pay them off and close them before you see the bank. So yeah, just try not to use them if you can at all really. So this is part of the advantage of working with a mortgage broker. They can take you through all these different options with your lending and the impact these might have before anything gets to a bank on an application form, and you can get rid of it if you have to. Thanks for tuning in.